Now, as we pivot to the U.S. and refined product demand, one of the things that we want to look at is where we are on the average, which is why when you look at that nice spike that we had during Easter, spring break, the average didn't get to where things are. And then you had that big overcorrection to the downside. And that's why realistically, we're going to kind of sit in no man's land between that 2017, 18, 19 level and then that 21 to 22 level. And we'll be better than 22 and 21, but worse than 17 through 19. And the reason why is a mixture of distillate. Distillate is struggling. We're going to talk more about it and then the issue is going to be gasoline, which we see gasoline demand being 10% below normal. Distillate we think is going to be the bigger issue, especially when you look at kind of the longer term view of where distillate is, where economic demand is. But again, it's not going to collapse us. It's going to keep us just below what was deemed pre-COVID or normal, where realistically we have to look at this kind of against the new normal, where we're seeing flexible schedules, like things changing a bit, and the spending profile also adjusting. And that takes time. That's not something that happens all at once, but things make impacts, make impressions. And those are some key pieces, as we've seen for anybody who has grandparents that were around during the Great Depression. I mean, that was a shifting factor. And it was always an interesting, anecdotal stories which I can talk about another time with my grandmother, which I always thought was fascinating. But again, these are some of the key pieces. Again, just some things to watch. Now, when we look at distillate fuel oil, there was a small drop of 580,000 barrels. 5-year average is down 15.7. But when you look at some of the builds in general, you're starting to get some of that slowdown. And when you look at storage, looking at that line chart, we should start to see draw slow, if not really stop, and then start to build as we get towards the middle of May and beyond. The question is going to be, when do the builds start? And our view is that the builds are going to start sooner, where typically they kick off, let's call it between May 12th and May 28th. We're saying it's going to start, first week, last week of April, first week of May, because of that slowdown in exports, the slowdown on the economic level, and those are some of the key pieces. Now, when you look at imports were down 21,000 barrels a day. Again, not too much craziness there in terms of some of the different shifts, but we don't see too much coming in from abroad. Maybe it does, just because Europe is getting a bit more normal on their gas oil storage. There's a lot of Russian product that's kind of taking some of those flows. So we could see some of your odd lots coming into both the East Coast and West Coast. But realistically, it's going to be the lack of our exports that will drive some of these builds. And that's already starting to show up in crack spreads. And you can see here that the crack spreads have just gotten decimated on the diesel front. And one of the things is we do believe that we get to about $20. That's going to really make a dent in, how aggressive or how quickly will we see some of these products, these refiners ramp up? Because it's going to be difficult understanding, just margin. And that's why we think that the Gulf of Mexico refiners are going to have, get hit a bit the hardest. And again, not to say that they're going to go bankrupt, or it's just, you have some expensive stocks that are going to struggle selling it to the export market with margins getting compressed. Like that I think that's a fair assessment given where we are and where crack spreads have clearly gone to. And that's some of the key pieces that we really want to look at. Now you look at distillate fuel oil in PADD 1, it's still at the lows. Then that's why we're saying, like, things aren't going to implode. It's just the demand is slowing. There's less exports, and that's going to put more in storage. PADD 1 will likely try to pick off some of the cheaper products that are floating around in the Atlantic Basin, but you're starting to get some of that swing back up here. Now, when you look at PADD 3 starting to grind higher. Now, this is the area we want to look at, because we think the builds are going to take out the 2023 highs, and there's going to continue. And to be clear, we're supposed to build. Our call is that the build starts sooner and the rate of change is faster, because of the lack of exports. And this is going to be the key one to watch as we progress through the remainder of, really the remainder of spring to see where we set up for fall, for summer. And here's when you look at distillate product demand. Again, flatlining, there was an easy comp. So realistically, the 5-year average should be higher. Again, it is what it is. Our main view is that it's going to be below the 5-year average, and that's going to continue over the next few months, given the pressure that we see coming into the trucking market. You can see it flatlining here. And some of these issues in terms of the availability, we're right in line with where we were in 18 and 19. But when you look at pricing, so the spread between contract and spot rates is near an all-time high at negative 92 cents per mile. It's almost $1 cheaper to ship a truckload through the spot market than it is to ship it through the contract market. And again, these markets are fungible, and the contract market is going to run towards this spot market. And it just shows you just an idea of how little demand is out there. We've already talked about rejection rates. It continues to move along those lines. And again, these are some pressure points that we continue to see as we look at rail traffic. So total car loads are up 5.1%. Coal is going to be the main driver of it. Motor vehicle parts, metallic ores. Forest products came down a touch. Grains, farm products, kind of a wash given last year. The biggest issue that we continue to see is intermodal. Intermodal is down 10.8% versus last year. UPS gave some pretty terrible guidance. Not that it's surprising at all. But again, you're just seeing the problems in the shipping world, not only just on the big stuff, the container stuff, but also the parcels, what is going to the consumer. And they're all interconnected in different ways. It's just what part of the supply chain are we looking at? And realistically, now it's gotten to the parcel side. And that's where, again, we see that continuous problem in general. So then when we look towards, what's coming into the U.S., you can see that, again, things remain light. We don't see too much coming into the on the coastal front, keeping things fairly impacted on that front. Then you look at U.S. outlook. Things have cooled off, as we were saying. We got a bit of a cold snap. That starts to pivot as we get towards the middle of May. But again, it's still a bit on the low end. So essentially, it's a little bit, let's call it the Rockies is kind of where, given it's a little east of the Rockies, but the Rockies is kind of your cutoff point where everything east of the Rockies is below, everything for the most part west of the Rockies is a bit above, and you can see that it's balancing out. Pretty seasonal. You're not going to get any huge amount of demand on natural gas or diesel, heating oil. You might get some clicking on at night just because you're going to get colder in the overnight, but still nothing too aggressive that's going to drive any real seasonal change. Gasoline had a nice drop, 2.41 million, and blending components had 2.12. Those are lining up, showing that things are fairly consistent. The 5-year average is 17.2 million below. But again, Pad 1 and Pad 3 had some draws. That's where we get the most concerned because we think those draws are going to stop. And not only just seasonally speaking, because when you look at the line chart, you can see that there's typically a little bit of a seasonal bump. But when you look at imports had a big bounce. They increased 322,000 barrels a day. That's 195,000 above the 5-year. And remember, imports, there's timing delays. So when that import shows up is going to be a difference. But one of the things that we've been talking about is there's a significant amount of gasoline in Europe. The issue was the shipping, the arbitrage that was really getting hit hard by shipping. But as shipping prices have come down a bit, that really opens up moving a lot of that product into the U.S. markets, especially given that Pad 1 is 10.7 million below the 5-year average. Enough storage space, enough of that pricing, because gasoline prices in the U.S. remain strong. So there's an arb to be had here, and that's going to close quickly. So we see imports remaining very elevated. And if you remember back, a couple months ago at this point, we had said that whenever that arbitrage opens, there's going to be a floating armada of gasoline coming from Europe to the US. And this is exactly what we were talking about. And we see that remaining elevated, which is why we do see builds coming into the US that is going to take us. Again, it's not going to blow us to new all-time highs. It's just going to move us right in line with the 5-year average, which realistically is not overly bullish or bearish, but it's just, again, it just shows you that the diesel crack is going to still have to do the lion's share of the work, and it's already struggling. So then when you look at blending components, as we said, things had, normalized a bit, but we see some of this turnaround and not so much because of the imports. It's going to remain because of the chem side where we see a lot of that pressure. Now, GasBuddy didn't have a new chart, but realistically, they modeled 8.7 million barrels a day of demand, which is, I just wanted to see it so you can kind of see it's maintaining realistically the 4-week rolling average, and that's what we've been saying. We've been saying between 8.6, 8.7. There's not much variation in that, and that's why we caution against, again, using multiple data sets. It's not just the EIA, it's not just GasBuddy, it's not just TomTom, it's all of them. It's, let's look at what everything is saying. And where, so when we look at GasBuddy's like, well, it's in line with what we were saying. And it's also in line with TomTom data, which is showing us that, gasoline in North America is about 10% below normal. It had a nice bounce off of the Easter low. Again, not too much in shifting. But the other issue, which we're going to dig deeper into on the segment 3, is when we look at Asia. So Asia Pacific, we had the Eid, the end of Ramadan. So typically you get a little bit of a slowdown. So this is going to be an interesting one to look at because you have Eid, then you run right into Labor Day, Golden Week, and you can kind of see that bouncing back and forth. It's just the bounce was very soft. And we want to see if that continues, because if things are slowing down more aggressively in Asia, it's only going to increase the push for run cuts, because distillate's already struggling, and this means that gasoline is now struggling, which is going to be problematic. Europe had a strong bounce again, as it did last year post Easter, and that's not something that we see changing. North America again showing some of those cracks as we go into May. Pricing doesn't help. I mean, gasoline prices fell a bit. You're still at over $3.64. Diesel, again, coming down a bit further, $4.16, as heating oil goes away completely in terms of just heating needs. Obviously some people need heating oil year round, but it's just the slowdown, so that you'll see pressure on diesel prices continue, which again is going to collapse that crack even further as that demand continues to wane. Gasoline demand, that strong bounce. But remember, as we said last week, the drop down was too aggressive, and now the pop up is too aggressive. And that's where we see it averaging out at the lower end of that seasonal level. And typically there's that bounce you can see in terms of where it happens is always going to be based on timing. But again, we do see that falling back down. Propylene builds happened aggressively, started right on time, but the rate of change was aggressive. A build of 3.43 million, and a lot of that is just driven based on the big slowdown in U.S. demand, based on not only heating, but also the petchem side. Jet fuel had a drop of 171,000 barrels a day, pretty much right in line with the 5-year, not too much of an adjustment one way or the other. And then as you can see, the jet fuel demand staying within our range that we don't see adjusting. Globally, the number of passenger jet flight schedules for the next 12 weeks increased 9.3%. Again, that's preparing for that summer push where we normally have additional flights. The number of passenger flights over the week of April 18th to 24th grew by 2%. And then when you look at passengers coming through, still in the U.S. staying right in line with seasonal norms. We don't see that changing. Yeah, and then here you can see the evolution of the global future scheduled flights. You can see that just where we are April 19th, the most recent revisions show a large number of canceled flights. And it's just going to be some of those revisions. So this will increase by 2.8%, coming back and forth. But you can see that there's still some of that lag and those slowdowns just given based on canceled flights, reducing some of those numbers, but still fairly comfortable within that confidence range that we've been showing. And this just puts it against historics where you can see things are fairly in line. But OpenTable, as we were saying, they redid their website. I highly recommend using it. But you can see the U.S. on a seasonal basis, you're starting to see those bigger impacts now on eating out, where you're pretty consistently now anywhere between 8%, 2% to 8% below normal. And that's, again, some of those impacts that are really starting to pick up when you look at consumer spending, which is why we see that additional pressure in terms of what the consumer does and what summer looks like. So that's what we have for you today on the refined product side. The U.S. side, we see some additional pressure points, some of that weakness coming into the summer versus some of those expectations. So again, that's where we see some of that pressure going forward. Next segment, we're going to look at the international markets and what's happening in the floating world as well as the physical spreads.